Welcome back and Happy New Year. I'm Ryan O'Donnell, co-founder of the O'Donnell Group. And today I want to share with you a story that I saw on CNBC as I was going over the major headlines of today. It was an article titled "The 5 Biggest Mistakes That Investors Make" by a guy named Tony Robbins. Now generally when I see these types of articles, I kind of tune them out, or I click there just to sort of make fun to myself about what they're saying. But when I read these 5 mistakes, I thought, you know what? 2 or 3 of those are very relatable. And so I want to just share with you. I'll share with you all 5 of the mistakes that he mentions, and I will elaborate on a couple of them. So number 1 of the 5 biggest mistakes that people make. Mistake number 1, seeking validation about your investment beliefs. This is very, very common when people want to try and time markets. When they think the market's about to crash, they go on the different news websites and they find all sorts of articles that validate their opinion. Or if they think the market's going to rally and it's really time to get in, they find all sorts of articles from analysts that say the market's going to rally 20%. This is a very dangerous thing to get into. From our perspective, prices are always fair at any given point in time. So if you have one of these urges where you think the market's going to drop and you have found 20 different articles that tell you the exact same thing, seek out articles to the contrary. Find someone to play devil's advocate for you. It's so important. People make this mistake all the time, and I wish they wouldn't. Mistake number 2, thinking recent events are an ongoing trend. This sort of gets to what we talk about a lot, about avoiding the noise. Just because the markets have come down over the last 3 months doesn't mean they'll continue to come down. In short periods of time, markets go up and markets come down. Okay? Try and avoid that. Try and avoid that. Mistake number 3, overestimating your abilities. Mistake number 4, letting greed take over. And mistake number 5, investing solely in the U.S. One thing we talk a lot about is global diversification and why that's so important. Only about 52% of the world opportunities that are out there in publicly traded stocks are here in the U.S. The other 48% are in international markets, emerging markets, and they all tend to perform differently. In fact, the greatest example I can think of is going back to 2000 to 2009 is what's known as the lost decade. U.S. stocks had a negative return for the first time in history over that 10-year period of time. However, if you had a globally diversified portfolio of stocks, that portfolio would have returned about 6% over that 10-year period of time. Why? Because although the U.S. was flat to negative, the international markets and emerging markets were up significantly. And so we don't want to ignore the rest of the world. We want to maintain a globally diversified portfolio. I think that's a huge mistake, and we see that the average investor in the U.S. has about 65 to 70% of their money in U.S. companies. That far overweights the actual allocation geographically. So again, we own in our portfolios, and if you're a client of ours, it's going to be about the same. You're going to own about 12,000 individual companies in over 44 countries. We think that's the right way to do things. If you guys ever have questions about what's happening in the markets or about your portfolio, by all means, give us a call, send us an email. We're happy to answer any question. Thanks for watching, and we'll see you next week.